Good afternoon. I'm Heather Ladage, Market President and Publisher at the Austin Business Journal, and I'm so glad that you could join us to our Tax Outlook 2021. Today we have 4 of Austin's leading finance and accounting experts, or as they just said in the green room, tax geeks, who are going to discuss tax policy and how it pertains to your business after a whirlwind year and a change in administration. Before we get started, I'd like to thank our sponsors today. We could not put on this program without them. They are Cherry, Beckert, Maxwell Lock and Ritter, RSM, and Whitley Penn. And I hope you'll consider doing business with them. Now I'd like to introduce and turn it over to ABJ's Assistant Managing Editor, Paul Thompson, who is going to moderate today's discussion. Paul?
Hey, thank you so much, Heather. I appreciate you introducing us here today. And I'm excited to introduce our esteemed panel for this chat. First up, we have Chad Wiley. He's a tax partner at Cherry Beckert. How's it going, Chad? Second up, we have Anna Stepan, a tax partner at Maxwell Lock and Ritter. Hi, Anna.
Hi.
Next, we have Scott Hegler, partner of tax services at RSM. Hey, Scott.
Hello.
And last but certainly not least, we've got John Karp, a tax and consulting partner at Whitley Penn. Howdy, John.
Howdy.
Is everybody ready to have a robust discussion today about taxes?
Absolutely.
Should be fun.
Exactly.
Well,
I
think a great place to start, I think, is something that's top of mind for a lot of people, is potential changes to capital gains tax rate. First off, I think the Biden administration has looked at a significant increase in that rate. And I wanted to ask all of you, what are some of the biggest questions or concerns you're hearing about potential changes to that rate under the current presidential administration? And I'd like to kick it to Chad to get us started here. And
yeah, Paul, for a high level kind of background, President Biden's really put forth 2 separate plans, and I call them both infrastructure bills, even though one is your traditional infrastructure, roads, bridges, that kind of thing. It includes some additional clean water, rural broadband, and the other one is really kind of human infrastructure, helping with education at all levels, paid leave, some college matters. And so the rates and the changes that are being put forth are really ways to try to raise revenue to pay for those 2 items. And so, as you mentioned, capital gains rates is one of the items that's been proposed, and changing it from what we have now at about 20% all the way up to potentially up to 39.6%. So pretty significant just increase in the rate. And so there are a number of things that folks, when they hear that kind of stark change, start to think about, and really the 5 that I've come across most often. One is kind of your low-hanging fruit of, well, gosh, if I'm going to have to pay 40% next year or 20% this year, do I accelerate some income in order to avoid capital gains tax rate increase? And there could be some legitimacy to that, but rarely do we just recommend somebody just go sell an asset just to sell it because. But nonetheless, it's a consideration. I think the bigger ones, though, are you're going to have these what I call one-time sellers, where you're going to have family businesses that really have one transaction. I think when we think about capital gains rates, we think about wealthy individuals, we think about maybe private equity sellers that have a number of transactions. But there are a number of sellers out there that are going to have one big transaction in their life that is really where they've been accumulating all of their wealth. And so now when you change the tax rate that those folks are going to pay on a sale by 20%, that puts a pretty significant dent in the cash that they have available to live the rest of their lives. So I think that's really going to be an impacted group. We've got this topic called carried interest, which catches a lot of press. And that really is just somebody for services receiving income that's taxed as capital gain income is really what it is, said in most plain sense. So clearly, if these rates go up, we eliminate what a number of folks have called loopholes, or they just don't feel that taxing income, service income at that lower rate. When you just increase the capital gains rates, you effectively reduce or get rid of this carried interest concept. So that's a really hot topic for folks that are more in the trade, or, in the business of raising money and having transactions. And the last thing I get a lot more questions about is, well, then if I'm gonna have to pay more tax, is there a way that I can defer paying it until later? And so deferral techniques are always of question, but sometimes when capital gains rates, or rate in general is really low, some people just choose to pay the tax at a lower rate and move on. Well, now when you've got rates at really high levels, there's a stronger desire to defer that income in hopes that either the rate goes down or they can keep their income at a level that doesn't trigger this higher rate. Because just for clarity, this higher rate is intended to apply to incomes over $1 million. So
Right.
there is a threshold that it would apply to. And so there's some gaming that try to keep your income perhaps below that threshold. So at a high level, those are the things that are most often asked, at least to me, when folks read about that change.
I think it's really important to remember, though, that the sale could stick your income or could put you in that above $1 million.
Right.
Right. All of a sudden, your earned income may be $200,000, but now you've got this sales transaction and you're at 1.5. Right. So now you're above that threshold. And there's other folks who think that's going to drop from $1 million to somewhere around $400,000 to make the budget work. So it should be kind of interesting to really see where the numbers lie as they keep working through the process. Hopefully we'll get some good insight from Congress before anything's ever permanent. So.
Yeah, and for clients who are asking about this, are you all kind of suggesting a wait and see approach on this thing? There's a saying where I'm from, the Midwest, so if you don't like the weather, wait 10 minutes. What's the sense on where this thing is headed? And do you just say, hey, hang tight on this because what we think might happen could change quite a lot in the coming weeks and months?
Who wants to feel best?
I can jump in there. This is
Sure.
Scott.
Scott.
So there's next week, the White House, they had issued a big letter really a few weeks ago that outlined a lot of the president's, kind of his wish list. Well, next week there's coming out a thing called the Green Book, which is going to have all the detail in theory. And of course, the big thing everybody's waiting for when this comes out next week is the details, but is this retro or not? That's where I think you're going to start to find your answers on some of this is are they going to try to retro it back to 1/1/21, or is it going to be what most people think 1/1/22?
Or, and if it's not 1/1/22, like if you think just historically, when they made capital gain structural changes, it's the date of enactment, right? So that they've gone through and they've said, okay, the date of enactment, and the date of enactment is the day the president signs it. So you have some information. So we'd see the bill as it's going through Congress and the Senate to know that, okay, if you need to pull a trigger, that you set yourself up to be able to pull that trigger. But it's not going to be like you wake up on Wednesday morning and by Wednesday night, everything passed and you had no idea. That I think there's going to be plenty of press on this, that we're going to have some good foresight. So I think the message is it's really difficult to give clients advice when you really don't know.
Right.
If you think about, not to be political, but if you think about Congress, right, nobody has a super majority. So there's going to have to be, so Biden may want the sun, the moon, and the stars. He may only get the moon because in order to get it passed, even under budget reconciliation, where he doesn't need 60 votes, he only needs a majority, he's going to have to compromise. It's going to have to be
Pluto.
Right. Right, go to Pluto. So who knows what that will really look like, but typically those capital gains have not been retroactive. The only, as I think we've all seen in the last year of our lives, is nothing has been typical. So I don't want to say that it's not going to happen.
Yeah, and
yeah,
Anna,
we've had a number of clients, even last year, as 2020 coming to a close, getting some sales done, out of concern for something happening in 2021, and even now we have, whether it's getting a land deal closed or getting a corporate dividend paid out, people, continuing to push that along because, as John mentioned, there's, it's possible that it could happen mid-year, and you'd hate to be, just a little bit late on that. And one thing we're telling clients, an installment sale can be a great tool for this because you can set it up, close the transaction 2021, but you have hindsight until you file that return late next year to really make your final decision. So that's in certain cases a nice tool to give us a little more time to make our final decision.
Yeah, and Anna, you mentioned land deals. I wanted to ask a little bit about something that I imagine residential real estate investors are asking a bit about. I've written a decent amount about opportunity zones and 1031 exchanges. I've heard opportunity zones described as 1031 exchanges on steroids, which I thought was an interesting description. But I was wondering if there's any talk about how those are handled and whether or not we might see changes to how 1031 exchanges or opportunity zones are handled from a tax perspective in the coming years.
Yeah, I like that description of on steroids because there are some really nice benefits. So, with the opportunity zones, I don't now hear any talk of taking those tax benefits away. We're really just still in the early stages of that program. What I do hear is talk about, certain policymakers and lawmakers wanting to add more reporting. So they're looking for more transparency around, are we getting a real economic benefit of these things into these communities, in addition to obviously the tax savings that investors are getting. So that's kind of what I hear, but nothing about that being taken away. On the flip side, for 1031 exchanges, absolutely yes. And that's part of the American Families Plan, which again, it's maybe Biden's wish list. We don't know where it goes, but they're talking about limiting the 1031 exchange to just 500,000. So you wouldn't be able to get that tax deferral on gains over 500,000. That'd be a huge, huge shift for a lot of our clients. You combine that with potentially higher capital gain rate and then layer on potentially, losing or cutting back on the step up in basis at death. And this is just a whole new world for real estate investors. I had a client who his basic plan was invest in real estate, 1031 exchange until I die, and then get the step up for my family. And that worked under our current rules. But, if some of these changes happen, then that's a big wrench in his plans. So, whether we're going to lose it, I don't know. I don't really want to prognosticate on whether that's going away or not. But I think it's important to think about, if we did lose 1031, the opportunity zone funds give a nice trade-off, right? That's another option for deferring gains that people can use. And there's a lot of rules, and that would take us, I think if we talk through it all, it'd take us beyond our whole time. But I think there's a couple of things for people to keep in mind on those. One on the good side for opportunity zones is you can you can put cash in just up to your gain amount, and that's different from a 1031 where you really had to invest your whole proceeds to defer your gain. So, and then like you said, the steroids part is, not only do you defer your gain, get a little haircut, but if you hold that investment for 10 years, then you're getting tax-free gain on that appreciation. So those are some nice benefits. On the flip side, people need to be aware that they are a lot less flexible. So there's a ton of rules around how you make that work. And then the hold period is long to fully maximize. So we're certainly in Austin seeing people are doing very well in real estate in timeframes much shorter than 10 years. So looking at a 10-year hold is just a different thing for people. So they need to be aware. And then also, when you do have that deferred gain come back up in 2026, you're paying on the rates that are in effect then, and those could be higher. So when you look at the overall picture, I think people just want to remember. But yeah, potentially big changes, but there's still other options for people there.
We'll see. That's interesting too. I've heard that phrase before, 1031 until I die. I didn't realize that I thought that was an original. I didn't realize that's something that people say. That's pretty interesting.
Yeah. Where this thing's kind of compound itself, even the real estate industry has done a really good job over the years, in my opinion, of finding ways to defer income and have some really nice benefits, in the tax law. But, as an example, when we talk about this carried interest piece, a typical type of income in real estate is called 1231 income, was carved out. It's tax. It can be taxed as capital gain, but was carved out of all those carried interest rules. And so where this thing starts to compound itself as well, now that goes away, if capital gains rates go up. So again, then it starts layering into some of the other things that Anna had mentioned as other strategies. And so that's where, for folks like ourselves, can spend a lot of time guesstimating how transactions can link themselves within these proposals. And until we know more, we just kind of, it's a lot of wondering and what ifs.
Is there a world where maybe clients might be shying away from these kind of maybe not opportunities on transactions, but 1031 exchanges, knowing that once they are realized they might end up paying a higher rate? Or are you not hearing people kind of ask questions to that with that kind of tenor? If
I think
anybody
that's the question, just when these rates go up in general, is one of the concerns is what kind of economic activity do you get as a result? Do folks who otherwise may be motivated sellers say, at a 40% rate, I'm not nearly as excited about selling a piece of property or any asset for that matter. So the concern always is, does economic activity slow because the rate at which they're going to have to pay tax on those transactions is going up? And so that would lead to your question, Paul. Well, do we just see a lot of assets in general go off the market just because they're not interested in paying that kind of tax?
Right. It's interesting. And I know, John, you made the point too, right, that none of this stuff is permanent. It's only as permanent as the current administration, right? So
Right.
If you try to plan for something that's going to happen in 2026, you might find a different landscape at that time, right?
Well, 100%. I mean, think about how many things in the Tax Cuts and Jobs Act may change, right? So we had some permanency. We no longer have permanency. If you go back to Obama, we thought we had some permanency. Things changed. So I think from one administration to the next administration, whenever they come out with tax legislation and say this is permanent, I think the real message is it's only permanent until the next administration, because anything can change with that administration, which I mean, I can say this for myself and maybe globally, that for tax practitioners, it makes it really difficult to do long-term planning today, because what we've seen over the last 10 to 20 years, there's been a lot of changes, right? And what we would have planned for even on the estate side is different today than it was different 10 years ago. And then it's going to change again, possibly. And then it may change back again. So I think it's really being, I used to say, look, we had to learn how to turn on a dime. And I think now we've got to learn how to turn and pivot on what's smaller than a dime, because things happen so fast.
Yeah, the pinpoint or something. Well said. Scott, I'll give you the opportunity for a final thought here if you want. Otherwise, we'll jump to a new topic, because I know we got some other stuff to chat about today.
I would just tell you, I think going back to what Chad said, talking to clients, literally had one in yesterday that had a transaction. We were going through it and kind of went through what if the change and how much less cash they would have put in their pocket. And literally, that's what my client said. If we had not been able to get this thing done and this comes through, he goes, we literally would have hung on to this business, for at least till the next election. So that's, that's what a little bit of the concern is, right? Is that, okay, everybody just holds and things screech. So, yep.
Well, we just got done talking about some transactions that have a lot of rules attached to them, right? So let's do a 180 real quick. And I want to ask you about cryptocurrency, non-fungible tokens, and the like. We've obviously been on a roller coaster this week. Part of it is just some uncertainty about how they're going to be taxed, how they're going to be regulated. And I just wanted to ask the group here, what's your advice to clients about how to handle their assets that are tied up in tokens, coins, non-fungible tokens, and the like at this point, and what might we all be watching out for here in the coming months and probably years as the government learns to kind of regulate this stuff better?
Paul, what's interesting is this has obviously made the IRS's attention. They now have an affirmative question on your return as to whether or not you had any transactions that were dealt in cryptocurrency. So it is making its headway. I think Scott kind of appropriately pointed out as we were just talking beforehand, the IRS is just generally steps behind where the market is in general. So we don't have perfect guidance here on cryptocurrency. What we do know is that the IRS has said that they're going to tax this like property. And what that means is that if you buy and hold a coin and you held it for more than a year and you sell it, then that will generate a long-term capital gain. If it's less than a year, it would be short-term capital gain. A lot of folks are earning coins as compensation or as proceeds from a sale. Well, if you earn it as compensation, it's treated just like cash. It'll be ordinary income to you. But I think the most surprising things that folks learn is that transitioning or swapping from one coin to the next is not maybe say it this way, it is a taxable transaction. And so, or if you use coins to go buy goods or services, you have effectively sold your coin, you have an income event, and then you have the after-tax money to go do whatever it is you want to with the coin. So there's a lot of transaction activity as a result of the IRS treating cryptocurrency that way. And it's you know, many things as we think we could answer with that set of rules. There's just a huge number of undefined questions that are to come. But right now we don't have any more guidance than what I put forth.
Oh, that's kind of fascinating. You mentioned about buying something with it is a taxable event. It doesn't sound like there's any sort of equivalent with crypto coins to something like a 1031 exchange yet. But maybe y'all can speak to that. Is that something clients have asked about? Hey, is there any way that I can carry this over or defer gains on cryptocurrency?
I think that at one point there was some thought about that. You know, it's property. I exchange one type for another. Can that be like a 1031? But with the TCJA, they clarified that 1031 is only for real estate assets. So that kind of took that thought process off the table. I think a couple of things, yeah, what Chad said, just this can get you a lot more than you would realize. It's kind of like money, but it's not exactly money. So there's a lot more taxable events than you might think. And I think the record keeping is really tricky. I think the exchanges and other software are sort of starting to beef that up, but it's still really gray. And a couple of practical points I would just add, you know, there's a question on your return, you know, so for us as your tax providers, we're going to ask about that. And I think, you know, so this is not under the table or in the dark. And then I just, in honor of my wealth management partners, they would say, you know, only invest in this to the extent that you can lose it all. Because like you said, it's so volatile and so much we don't understand. So.
Yeah, well said. It's these aren't the coins that you might find in your couch cushion, right? I mean, that there's some real money behind this thing, and if you're going to invest in it, you have to assume that sort of risk. Any other thoughts?
Real money lost. You know, my son who's in college called me and said, "Dad, I want you to buy me some Dogecoin," and it was about 75 cents.
Yeah.
And of course, I said, you know, I really am not set up to buy that for you. We can't do that in Fidelity or any of the common brokerage houses. And so the other day I said, you go look at the value. Aren't you glad I didn't buy it? You would have lost your money. And I think that, I mean, he wouldn't have lost it all, but it's now at what, about 25 cents. So he would have lost, you know, 66% of his funds. And for a college kid, you know, whether it's $300 or whether it's $500, it's a lot of money. And
right.
It has massive swings. And, you know, I think we're going to see some emotional and some mental problems that it's caused for some people that put too much in that bucket.
And Scott, any cautionary tales you've encountered in that space?
Just, you know, we definitely have some clients that have invested in it, and like, you know, Anna mentioned, the IRS, they're going to start coming after this stuff. They're always behind, but it's hitting the radar screen. So just keep your documentation thorough, because at some point you're going to need it. And it's not a toy, it's real. So the IRS does get persnickety about it.
You know, Scott, that brings up a great thought that, you know, you talk about documentation. Clients always call me and say, hey, how long do I have to keep something? How long do I have to keep my information? And when you're dealing with Dogecoin or any asset, remember, you have to be able to document the basis of that asset for when you sell it. And so it could be forever until you dispose of that asset. And so don't, right, I think it's, as you said, make sure you're documented. So, you know, it's not a 3-year tax statute. It's not a 7-year tax statute. It's until you dispose of that asset that you put, when you put that on a return as basis, you might have to prove that number. So make sure you have that data available.
Well said. Thanks, Al. That was a robust conversation. I appreciate being willing to chat about that. I want to pivot a little bit now to M&A activity. We've seen a surge in Texas beginning in the second half of 2020. The data from Merger Market in the Texas Law Book shows that Texas saw $220.6 billion across 552 deals in the second half of 2020. And that was up from $38.1 billion across 470 deals during the first half of the year. Obviously, there's a lot of reasons for why the deal making might have been down during the first half of 2020. We don't have to dive too far into that, but anecdotally, it seems that this trend is really perking up and continuing into 2021. I think I just wrote yesterday about Wheel, a telehealth company in Austin, with raising a $50 million round. And I think we're seeing more and more every single day. I wondered, what do local companies on both sides of the M&A process, whether they're fundraising, whether they're being acquired, whether they're merging with another company or acquiring someone else, what do they need to be aware of when making these deals, when they're thinking about tax implications? And I might kick this one to Scott first, if you don't mind jumping into the M&A world.
Sure. So there is the activity is red hot, right? And you couple that with the change in the election and the fear, right, of all these rates are going to go up. So it's even hotter than it was. My first thing I would tell you, anybody that's on this session, if you're thinking about it, you need to get, kind of going quickly. Just as we talked about amongst us on the pre-call, it's busy and it's only going to get busier. And at some point, you got to have valuations, attorneys. I mean, there's a lot to it and a lot of stuff to coordinate, and everybody's already getting pretty full. So that would be my first comment is if you're thinking about it and you're worried about tax rates, you better, start today. And the other part I would say, just both sides, is the due diligence side of it. So if you're thinking about selling, we talk to clients all the time of making sure you're ready, because the buyer is going to come in with some due diligence team, and that we just see it all the time. It drags a deal out with issues around, say, like sales tax. That's an easy one that always seems to kind of drag a deal down. So always advise our clients that are selling to do your due diligence ahead of time. That helps speed it along a lot. And same with buyers. Just again, it's a busy market, and if you got money, you hear the term dry powder all the time, right? There's a ton of dry powder out there, a lot of money to invest. So be prepared.
Anecdotally, can we compare, you said the amount of dry powder currently in the market today to really any other time in Austin's history here? Is there a comparison to be made, or is this sort of unprecedented at this point?
Well, I would say, as things have moved along more here, so it's gone up a lot. The private equity groups definitely have. Austin was not near as on their on their radar as the Bay Area, Chicago, New York, Boston, right? But that's definitely seen a big uptick in that. So the portfolio, the companies that are selling locally to these these groups, it's gone up a lot. So I mean, I think based on the stats that you just referred to.
Paul, when we talk more about the M&A space too, with all these potential changes coming, I think structuring becomes really, in my mind, kind of front of mind and name of the game. And that is, if you're a buyer of a business, and you really need to understand, well, when I buy this business, what is my intent? Am I buying a business that I intend to own for a long period of time? It's going to produce a lot of income for me that I intend to live on and take out of the business. Am I instead in a growth mode where all the earnings are going to be recycled and put back into the business? And all that leads to a structuring question of, well, how do I most tax efficiently get money out of this business? Or when I go to exit, who is my likely buyer? And am I set up in a way that I'm an efficient seller at some period of time to make me an attractive target? On the selling side, we're seeing, again, with the structuring piece, a lot of these deferral techniques start coming up as to, is there a way that I can defer income or at least have some control or over when that might be recognized. When the 17 rules came into play, kind of in the Austin space, being more of a middle market space, C corporations became a bit more interesting for people. And with that C corporation trend, you start hearing a lot more about what's called qualified small business stock, or some people call it 1202 stock. And that just allows you to completely, up to certain amounts, exclude that gain from being taxed at all. And so I think it's really important as you're getting into that space to understand, not only, like I said, we got a lot going and the market's moving fast, but how do you best position yourself both on the buying side and the selling side to have tax efficient transactions to accomplish your goals?
Yeah, well said. And I wondered too, just about sort of the makeup of the companies that are involved in these M&A transactions in Austin these days. Obviously, we're seeing a lot more public companies, right? We're seeing a lot of private companies with huge bankrolls moving into Austin. I wondered, are you all just seeing that there's this sort of influence from the coast coming to Austin as it relates to M&A too, and contributing to the amount of dry powder that's out there? And if so, how does that compare to anything else you've seen here locally? If y'all don't mind jumping into that.
Sure. I really talking, the activity is high, but valuations for some of the, these businesses extremely high as well. We went through a period of time where that maybe wasn't the case, especially in the technology space. Some of the transactions we're seeing, just the prices that businesses are trading at are pretty high, and I think that is the influence of people moving here, and Austin being a great place in Texas, more broadly, to be a great place to grow a business. So certainly transaction activity, being up, as are our values.
And I'll put you all on the spot here. Is there a risk that we're sort of hitting the top of the mountain as it relates to values, valuations, and the like?
Man, somebody's
That
gonna
is a loaded question.
I know. You just said there was silence. I don't think anybody wanted to
Exactly.
jump right into that. Every time. So I deal a lot in the healthcare space. I know, like, I've got several practices in the Austin area, and they're constantly being looked at, and understanding what you're buying and how to do the restructuring. But you wonder, several years ago, medical practices and large groups were being gobbled up, and then I watched all these large groups buy themselves back out. And so the answer to your question is, time will tell, but I think we all would have thought the market would have, while it's dropping, I think all of us thought we would have been tanked last year, and we didn't tank. So, if you would have put us on 6 months ago, I think we would have talked about how the economy was just headed for a slow decline. And yet, the past 6 months, forget the last 2 weeks of our lives in the market, but it didn't happen. So I think it's a really loaded question, because, I know for myself, I don't have that great crystal ball. I wish I did. I wouldn't be on this call if I did. I'd be living on the island.
Exactly.
You living on top of that mountain.
I would say, just on that topic, that, if you look at the activity right now, I'd say, if you project it out, say, through the rest of this year, you'd say no way, right?
Mm-hmm.
There's just, you're seeing companies get bought up that have no revenue, right? They got a software, they got an idea, they got no revenue, and people are paying a ton for them. So, and that's happening all the time. So, we'll see if the tax rates, what actually ends up happening with that. I'm obviously, as Chad was alluding to earlier, that starts, you raise a little concern of people say, well, I'm going to, now I'm going to pump the brakes a little bit here, because, the rates are high, and I don't want, my gain out there, to half of it get gobbled up in tax. So.
Well said.
I think inflation also.
Oh, go ahead.
I was gonna say inflation is going to weigh in there too, right? As we see some inflationary issues coming, I've already talked. It says, hey, look, we're headed for some inflation, and milk's going to cost more. And I know of anybody who's entered into construction, they may have taken a pause, right? The price of lumber's, with all the different disasters, has gone up threefold just to buy a stick of wood. So, some of that's going to play into this, but how? Who knows? Like, it's just hard to say.
Yeah, if you talk to anybody in the real estate space, and I don't know what you're seeing on your end, but they're going as fast as they possibly can to get units and to get things online for folks to buy or to move into. That market is they just cannot keep up. So they're I think optimists by nature, but certainly that Mark, you read about that all the time, where housing market continues to set new records, and mixed family space, and obviously we got the questions about what the commercial space will or won't do as we come out of COVID. But certainly on the residential side, we were just setting records, it feels like, by the week.
Yeah, that's for sure.
There was a news story last night. Someone just went into $1 million house, and they wanted to make sure they got it, so they offered $1.3 million.
That's wrong.
So you're right. I mean, the residential real estate market's on fire.
Any final thoughts on this, Anna?
I was just gonna, have seen that with my clients, residential home builders. 2020 was a banner year for them, and that just keeps going. And even, down to the furnishings that people put in the house, those companies have done really well. So.
And this is sort of tangential to the M&A activity in Austin, but obviously there's a lot of companies here that are still private that might have ambitions of one day going public. Bumble's a great example of one that happened really recently, but you also have companies that have local ties or started here that are going public via SPACs and other sort of alternative vehicles. I wondered if y'all might be able to speak to just how much work goes into the process of a company moving from private to public, and if you have any experience there, you might be able to share to our readers and our listeners who might one day have ambitions of making that transition.
So, I mean, I could jump in there. We've done a couple of SPACs here. So it's the gun sounds, and it is an insane sprint. Once that LOI hits. So now the SEC and I believe the FASB came out. They had an accounting change. So if you saw that too, it was hot. Again, just like everything else, right? I mean, there was just everybody couldn't find a target fast enough, and then that accounting change happened where. Not to get into the details, but it was a significant. So like I know, we had a couple that you literally have to go back and restate their financial statements, and it's a major change. So that the SPAC market has at least again kind of pumped the brakes a little bit until everybody figures out how that's going to work out. But I would tell you, just like the M&A, what we see, especially with the target, so it's a local company starting up, their accounting is just not, once you go from private into that public realm in accounting, the standards just go up tremendously. And that's, the other thing I would tell you is that's always very surprised to the targets is the audit and the scrutiny, and not to say that they don't keep their books and it's not where it needs to be, but once you move into that public realm, it is a different ball game. So, again, you better have your shoes tied tight because it's a pretty rigid and fast-paced event.
No, excellent. Thank you so much, Scott. Any other thoughts on that front before we move on?
Yeah, so I'm trying to remember where it was published. There was this whole article that says SPACs here to stay, and what Scott gave you was the company side, and just remember that as we talked about Bitcoin being a very volatile investment, a SPAC could also jump way up and fall really quickly. I mean, we saw that with a couple of them, and there's a couple that they're investigating, and there's some class action lawsuits going on because when you buy a SPAC in the marketplace, remember you're buying a blank check company that really doesn't have any history. You're just hoping they go choose a company to merge in, right, in the whole acquisition process on that LOI that has real operations. And so you're kind of buying on blind faith, depending on who's running that SPAC, and just praying for the best. And so I think that's why companies go in there, because it's not as difficult to go public under a SPAC as it would be on some of the other methodologies of going public. That's about all I know about SPACs.
Well said. That was a nice soundbite there. I appreciate it, John. Really interested in take on that, and we'll see what happens with it. I mean, so much the story is yet to be told on SPACs and what the long-term benefit of them is, and how successful they can be on the public level. So we'll see. I want to pivot again. This is a little bit inside baseball, but in January, the Texas Comptroller of Public Accounts amended the Texas franchise tax apportionment rules, and I wanted to ask, maybe we'll start with Anna here. How is that going to impact local companies?
Yeah, so I think that you have nominated me the biggest tax geek here by taking that question, because we're moving from the flashy M&A to the apportionment rules. But so this is not a national news item by any means, but it is a pretty big deal for our local companies here. So like you said, at the beginning of the year, they did a pretty significant change to some of the rules. All of our clients that are here in Texas are paying the franchise tax, and it was a overall beneficial change. So it's something to pay attention to. So to be a tax geek for just a minute, just to give some high level context for those on the call that aren't tax geeks, apportionment is how we get from, companies' overall taxable income, what they pay at the federal level, to then, what do they pay at each state. And all states have a rule about how you do that calculation. And the way it's been going really is states are trending towards more and more doing market-based sourcing for services. So, looking at where does your customer benefit from the services that you're providing. Texas has been a bit of a holdout on that, though. So until this recent change, for the most part, for service and tech-enabled service companies, we were looking at where do they provide the service, where are they physically doing it. So if you think about, a tech-enabled service company, they're headquartered here in Austin, most of their people are here, and they're providing services for, clients all over the country. They're really taking a hit because they're paying tax on it in Texas, and then California says, well, no, that's our income. And so that was a pretty bad spot for our clients. And there's quite a few companies in that position. So the amendment that just passed has really pushed Texas way more towards market-based sourcing for a lot of services, for the technology and internet type services and a number of other things. And so, we could go way in technical weeds, but just, I think, a couple takeaway points for people listening. These changes affected businesses, again, services, internet hosting, which is broader than you would think, advertising, digital property, broadcasting, transportation. There's a little bit of a longer list. And in the most cases, the changes are retroactive. So we're not just talking about this year's filings, but the ability to go back. So I would just say, for people who have businesses in that space, and especially if they have been paying a pretty hefty franchise tax bill, this is something to look at and something to bring maybe to your tax advisor, because you could be having a much better answer this year, and you may also be able to go back a few years and amend and get some refunds. So we're doing that literally right now. The Texas franchise deadline is June 15th. And so as we're working through current year, we're seeing opportunities for people to go back and, in some cases, get a pretty good chunk of change on amending. So again, not the headline news, but a little more nuts and bolts, but it's meaningful to a lot of the companies here in Austin.
Hey, don't sell yourself short on that one. This is for the real tax heads, right? It's good that we're talking about this kind of stuff.
We are in Texas, so it's good. It's good sound bites for Texas, right?
Yeah. Well, I think it's really interesting, and you're talking about potential benefits for companies. So obviously, it's not something we want to gloss over too much. And I'd like to ask the rest of the group too. Is there anything else you want to add to this? To these new rules about franchise tax apportionment? You think she covered it?
Yeah. Well, yeah. So Anna did a great job, and I think the message is, if you're in those businesses, you should go talk to your tax person, because you probably have money to go get. That is the rule. And they're, again, like Texas and like a lot of law, right? So it came out. There's not a whole lot of guidance. I'm sure we'll get more. So right now, it's nice to be able to have some freedom. You got some positions you can take and document them well. And then, as time goes on, we see how the state comes out with additional guidance, but it's kind of nice because right now it's fun. Like, that's why we're all tax geeks and we're not auditors, because that's the fun stuff. Is you got some rules to work with that are gray, and take advantage of it.
You said you probably have some money to go get. What's not flashy about that headline? I think
Exactly.
I think people would be happy to see that. That's really cool. I appreciate y'all weighing in on that. Let's not sell it short. I did want to ask, moving on here, I wanted to ask a little bit about the CARES Act, some of the federal funds that have come in here, something we talked about in our pre-call a little bit, but obviously, the feds have dropped a lot of money into industry. One example that I just picked out is that I saw, 178 billion is being distributed to hospitals and healthcare providers that have been on the front lines of the COVID pandemic and fighting it. And, paycheck protection program's another one. There's money set aside for venues and stages and that sort of industry. And I know the governor's signing bills to keep some of those taxes consistent with federal laws. But I did just want to ask broadly too, before we go too much further, because so many people have been getting federal money and participating in these federal programs. What are some of the tax ramifications of all this federal money that's been coming in over the past year? And John, do you think you can jump on that?
Sure. You know, it's interesting because on the PPP money, while the forgiveness is not taxable, there's still a lot of questions around S corporations and basis, and we haven't gotten great clarity yet. And so I think, and by the way, back up, when I said it's not taxable, the forgiveness isn't taxable, understand that I still get questions. Hey, I understand that if I apply for forgiveness and I get forgiveness, it's taxable income to me. So even though as tax practitioners and paying attention, we know it's not taxable, that people kind of got their money, they've used it, and they remember the old rules that were back in April, that came out in April. And so, you know, it's kind of, I still get questions on, hey, how much does my next house have to be when I go buy it? And that law is so old in terms of trading out houses. You know, it's right, we're limited, right? I mean, I still get it though. And so I think it's important that folks understand that when you're forgiven, it's not taxable. What they haven't told us though is how to calculate it into basis and where it really belongs on certain tax returns as the S corporation. And it's up in the air. They've said guidance is coming. Let's just hope we have it by September 15th. You know, that's my wish, because there's a lot of us practitioners that are holding those tax returns up that to see what's going to happen, so we know how to deal with that. The other is the Hhs funds. And so if you're a large accrual-based taxpayer, this isn't an issue for you. But when you break it down into a cash basis taxpayer, like with some of your medical practice, and when I say medical practice, you could have $100 million medical practice that's on cash basis. It doesn't, right? Because it's service-based industry. And what the government has come out and said is the money is taxable when you get it. So then if you have to pay it back, it's an expense for a cash basis taxpayer. So you then have this, and you can use some of that money to pay the tax on it. So, but again, it's caused confusion because, well, if you got $1 million, let's just say 30%, you got to pay $300,000 in tax. If you have to pay it back, you still got to come up with $1 million.
Right.
Then you get to expense that payback in the next year. There's a lot of people who there's a lot of people I know that just have it out there on their balance sheet. They don't know if they're going to qualify yet. I mean, I have one client that had about $11 million of it. They think they're really going to qualify for about 4 and have to return the other 7. So it's caused some, and again, the guidance hasn't been great. It hasn't been great, and that's the only guidance is it's taxable if you're a cash basis taxpayer, not accrual basis, because you can't put unearned revenue on your balance sheet.
Well, and so many of these programs were rolled out so fast because of the incredible need, right? But some of the rules and regulations, I think one of the big sticking points early on was, wait, what happens if blank? What happens if blank? And those answers weren't necessarily answered right away, or maybe they just didn't have them either, right? So any other thoughts on this that y'all think people should be worried about, or your clients are worried about, who have maybe been the beneficiary of some federal funds and aren't sure exactly?
I think, Paul, the thing that just as a general statement, not to get too far in the weeds, but if you're an employer of any size, the words I leave you with is an employee retention tax credit, and that is something that when COVID first had hit and the government was coming up with a number of different programs to try to help businesses sustain themselves, there wasn't a good interlock between how to get the PPP money that got all the press and how this retention credit might work, because if you took one, you couldn't take the other. Those rules have pretty drastically not only been retroactively redone so that you can take both, but the way that you qualify has become much more simplistic as well. And so it's something that's starting to catch a lot of press. And again, but basically you can get, for 2020 up to $5,000 potentially per employee in terms of a credit. And then in 2021, we've now expanded it to all 4 quarters, such that it could be, and again, big underline on could be, up to $28,000 per employee. So there's a lot of nuances there and ways that you need to qualify, but I think it's worth making sure you have a conversation with your provider to say, is this something that would make sense for us? Because there could be some dollars, and they're refundable credits, meaning the government could actually write you a check for those credits. And it's just something that didn't catch quite the press when it first came out, but it's certainly something that's alive and well, and we're doing a lot of that for people now that these rules have changed.
I have a client, we did some calculation of a client getting about $140,000 back. So that's, and they're just writing them a check. And I think the reason why, back to Chad's point, why it wasn't getting a lot of press is because as practitioners, we were looking at it saying, well, the PPP money, most of our clients all got the PPP funds. Well, you can't use the same money for the ERC, for the retention credit. Therefore, when we were all talking about PPP and, you know, idle loans with our clients,
Right.
that was far away, right? Because we couldn't have them in the same conversation, whereas now we can have that in the same conversation, which is really important. I think the other point on May, I think about May 5th, I think it was I can't remember if it was, I think it was May 5th was when PPP money ran out. Everybody should know that. What I did find out this morning from an AICPA call was if there were loans that were in process under review and had notes, most of the SBA said, know that your loan won't get funded. And what they came, that's what they had said. Well, they came out this morning. So, who knows how good this information, if it's really going to happen this way, but they said there's enough money that whether they found it, whether they've gotten refunds, who knows, but there's enough money that if it was in the system, it will most likely get funded. They had your application on the 5th, it will most likely get funded. And then the Restaurant Revitalization Fund closes Monday, right? If anybody is going to close out Monday, and that again, we'll see if they put more money into that program because it ran out right away.
Right?
Yep.
So, but I think it'll be interesting. It doesn't sound like there's going to be new money coming for like a PPP3 from everything, right? So, like even this morning when they talked about, they found money that the loans would get processed. They were under review and they were trying to clear some error codes because a week ago they said, so sorry, there's no more funds. Your loan is just going to get kicked out. And there is about $6 billion left for the CFI communities, so community banks.
Well, I think that was actually pretty illuminating there. My apologies on behalf of the press broadly for our shortcomings and letting the public know about this stuff. I'll take the brunt on that one. We did our best, but it was quite the deluge there. But I did learn a lot about some of these hanging chads that are still out there. So I appreciate y'all. Keep throwing the knowledge at us. I know some of this stuff might seem rudimentary to y'all, but the normies like me, sometimes we just need to have this stuff. You know, we need the hammer and the nail hit on our head to really get through our skulls. So I really appreciate that. We are sort of running low on time. I wanted to ask y'all one question. I'll throw to the group, and hopefully we can get to it fairly quick. Someone said at the beginning, right, we could talk all day about this, and I believe that. You know, now that we're 55 minutes in. But I wanted to ask you about your clientele generally. I mean, one of the things we chatted about today is how much Austin has changed. Companies coming in from the coast, huge corporations setting up shop in the skyline is looking different every day. If I've been working from home and I come in, I haven't been downtown for a month or two, you can see it. It's tangible how much things are changing over just the span of months, much less years. But I wanted to get a sense of how your clientele has changed over the course of time. Can each of you maybe say a few words about how your typical Austin client has changed over the past decade? And maybe Chad, you want to kick us off on that one?
Yeah, you know, gosh, lots of ways to take this in terms of just the number of transactions, the way that you know the folks are just having really nice exit events. You know, for us, I think we've seen quite a bit of that. Lots of opportunity for people to invest money. Also seen a lot of people that are moving into Texas lately. You know, knowing they may have an exit transaction, moving from states that maybe have state income taxes. They don't like the outcomes there, and so I think. You know, a lot of people moving into Texas and again into Austin. Obviously, first and foremost, because it's a great place to be. But there are some really beneficial reasons from an income tax perspective and a state tax perspective to move into Austin. So you know, just the number of people. You know, for me, the age number that I've also noticed with folks that have had really nice transactions seem to be declining, you know, in terms of having, you know, a number of technology type companies in town and people just having, you know, successful businesses at a younger and younger age. So certainly, you know, notice some interesting trends, but that's what, at least for me, what I've seen.
Chad, does it make you feel like we're missing out? when you see our age group peers and younger and how well they've done.
Exactly.
I would say, along the lines of what he said, with the exception of my real estate clients, I think through them, and every single one is venture backed or private equity backed in some way, and I don't think that was true 10 years ago. And there's been nice exits and multiple rounds of private equity funding coming through. So that, again, just as Austin becomes more and more desirable, I see that across my client base.
Interesting. Thanks. Scott, any final thoughts there?
Yeah, I mean, certainly just to add to what you've heard, to me, I deal a lot in the state tax world too, and the rules have gotten a lot tougher. And you'll hear this all the time, right? The states are broke. They don't have, they can't go like the federal government in general and go into a deficit. And so you've just seen a lot more in the state tax where, whereas, and you could kind of get away with it, right? Where Texas, and I don't know how many clients I had to tell me, you can come get me and I'll pay. But other than that, and that's just changed, right? You just can't not do that. And then I'd say the same internationally as well. It's just, as the businesses have moved here and our clients have expanded, the international tax aspects kind of popped in there some too. Whereas, like I said, 10, 15 years ago, tax return, franchise tax, and pretty much you're done.
John, you want to have the final word on this?
I think I would just be brief and brevity, and I would say clients have become more global. It's bigger and more global, whether it's interstate, international, it's just a interstate, it's much more complex than it used to be.
No. Well, well said all. I really enjoyed our conversation today. I think we pretty much got to the end of the hour, so that's all we have time for, unfortunately, for us and for everyone listening as well. Thank you all so much for joining, and especially our sponsors and panelists today, from Cherry Beckert, Maxwell Locke and Ritter, RSM, and Whitley Penn. I really appreciate everyone. We wouldn't have been able to do it without your participation and without that of our sponsors as well. One final note, we did record today's session, and a link to that recording will be sent tomorrow around this time. So with that said, have a great day, everyone, and embrace your taxes. All right, thank you so much. I appreciate your all's time, and thanks for being here.